Yeah, and I'll tell you a funny story. I went on the site visit, and Tim's there, and then his brother's the CEO, and I'm like, oh, I wouldn't say it's a red flag, but we're always a bit cautious about that. And then we drive up onto the ROM pad, and he starts giving some guy up on the ROM pad a bit of lip over the radio, and I'm like, geez, you're being a bit rough with one of your workers. And he turns and goes, oh yeah, that's my dad.
Righto, buddy miners. There's bloody fund interviews galore this week. Just like there's as many fund interviews as friggin' that ground support variations you can get from Sandvik Ground Support. They're everywhere. They're bloody JD, Trav. Test. What are the different types of ground support? You've learnt this over our journey.
This is a trick question. There's only
what types of bolts?
There's only one, and it's Sandvik ground
Just
support.
Sandvik.
Yeah.
The kings of the industry. Kings and queens.
Got out of that bloody well, didn't you? Right. So if you want split sets, mesh, posi mix bolts, MDX bolts, dynamic support, static support, friction support, whatever you need, Sandvik Ground Support is the only bloody name you need to remember to supply the whole thing.
They keep you feeling comfortable, mate. They keep you feeling safe. And just like this bloke here, Mr. Rick Squire, just makes you feel comfortable when you're talking to him.
Mate, I liked his top five. He's different to the. It's not early stage exploration. He's punting on the risky part of the Lassonde curve. That's what I took, which I like the way you're thinking.
Yeah,
that's what I sort of took of it.
Big operational leverage in some of his big holdings in rising markets. Yeah, that's a fair observation, I reckon. And he's got really interesting thought process and how he's allocating the funds at Acorn, and big exposure to gold right now. So the gold bulls get lots out of this chat.
Yeah, let's cut to it. Rick Squire.
Here we go. Righto, buddy miners. We haven't had you on for a full Rick interview for a very bloody long time, Rick. Rick Squire from Acorn Capital manages the Next Gen Resources Fund, which doesn't just invest in Next Gen. It is the Next Gen with a T. How are you, mate?
Yeah, well, thanks.
Where should we start, guys?
Right.
I reckon rare earths, Rick. Rare earths are
Is that what you were thinking, Rick? Where to start?
Oh, it's a fantastic idea to start.
You've spoken about rare earths in the past. You mentioned them when we had you on for the convictions pick not too long ago, Rick. And I'm keen to get your latest take, because even when we spoke, like Maddie referenced, a long while back, you were excited about rare earths. You were talking up the kind of deglobalization, if you will, and the fragility of the supply chain. What are your latest thoughts?
Yeah, look, I think what's coming out of the US in terms of the tension with China, it's really highlighting the impact of particular commodities like the rare earths, and it's that real strategic importance which is the key. So then for investors, what you've got to think about is, is it the biggest project? Is it the highest grade? What's actually going to be able to fill this gap? And to do that, I think you've got to take this big step back and say, well, why does China actually dominate the market? What happened to allow that to occur? And what it is, it's actually a geological bias. There was back in 1970, the Chinese hardly produced any rare earths at all, but they made this discovery of these clay deposits that contained rare earths that were really easy to mine there and to define the resource, really easy to mine, very simple and low capex to actually extract the rare earths. And so that totally transformed the industry. And then from there they went downstream because they captured that front of the processing route, that they then went downstream and then started to dominate the production of the magnets and everything from there. So if anyone's wanting to break into the market, you've got to look back and say, well, do you want to start with a really large and complex and extremely expensive processing plant and try to break in on something that could be 10 or 15 years of commissioning, or do you want to start with a project that's actually a reasonable capex, easy to define that resource, to extract the metal, and then to slowly go through that process of creating value. And that's where I think investors have got to be wary of some of the claims that are out there, because it's an exciting market, great place to be, but geez, you could definitely back the wrong horse in a pretty exciting race.
One of the like lessons in our head from many rare earth discussions is to back the incumbents because of the huge barriers to entry to actually, get somewhere meaningful in that industry. You have a preferred type of investing of actually backing earlier stage projects. What gives you the confidence to back them instead of incumbents?
Yeah, sure. So then we've got to think about what is it that's changing in the rare earth market, and certainly, Lynas is the incumbent. They're up and going. They're producing, but they're producing predominantly neodymium and praseodymium. So they're doing the NdPr. There's not large amounts of the dysprosium and terbium. Now they are trying to move into that part of the field, and they're building a plant in Texas, but they're still along that development pathway, and so then you've got to say, well, what's actually creating this tension at the moment? And certainly the supply of NdPr is an important part of that. But if we want to look at robotics, which is really the exciting part of the future, and that for the robotics you need the dysprosium and terbium, because when you mix those two rare earths into the mix, that's when you produce the really high strength magnets. And so 4 years ago there was a little bit of tension around that, but it was there was a realization that in the big wind turbines you can get away without it. It's not absolutely essential for those wind turbines, and there's even talk about not using them in electric vehicles, but in robotics it's actually very difficult to get away from it. You need something that's small, condensed, really strong. And that's what the dysprosium and terbium does. So then if you want to find that, Lynas is not really the best company for it. And yes, they do have some at Mount Weld, but it's not an area where they've mined and produced large volumes of that material to date. So it's yes, they are the incumbents, but they're slowly moving into that field. And this is an opportunity where I think some of the smaller, nimble companies have got the potential to steal the march on even companies like Lynas.
Looking at yeah, I don't know if this relates or not. I might be going off on a tangent here, but maybe I've just picked it. One of the other top 5 holdings, Petratherm, is based around titanium. Is this all part of your robotics theory, that you've got a thing about the growth of robotics and the need for titanium, heavy rare earths, or have I not even close?
No, look, I'm a very sophisticated investor, but there was a lot of sort of dumbass luck in the Petratherm discovery that we actually went into them when they had a rare earth project, but it didn't play out, and it didn't match up to what we had, and so I went out to site with Peter Reid, and he showed me his copper projects, and I thought, oh geez, they're fantastic. He had some, they were picking up ground, and to a lot of credit to Peter and the team at Petratherm. And when things were tough in the space, they were still picking up ground. They were, doing deals with neighbours. They were, and they identified this project area in South Australia, not far from Coober Pedy, and then they went out and did some field work, and that's when they discovered the titanium. And the really exciting thing about Petratherm, I think, is it's not just titanium, because there were some really large low-grade titanium projects, but they require really big capex and a lot of technical and financial risk around developing them. Whereas what they've got is an unusual mineral sand project, which has got these titanium-bearing minerals, which is rutile, and they call it pseudo-rutile, or leucoxene is the mineral they're after. And that or they have those deposits. They have unusually high concentrations of those minerals, and they're actually a good grain size. You don't want them too large, but you definitely don't want them too small, because it's very difficult to extract it. So they've discovered something that's really exciting, and that's why we continue to hold it as a large weight in the portfolio. That it's an unusually large something that has potential to be an unusually large deposit with very high grades of mineral sands where the grain size is the perfect size for extracting it. Now it's early days. There are obviously risks in developing these projects, but that's something I'm really excited about. But it's it's not picking the metal. It's more that that opportunity came along. We saw it, so we leveraged that, and we've increased our stake in the company.
It's got favourable assemblage, favourable met so far, new discovery, but its share price has been pretty stagnant for the year to date so far. Obviously the discovery made waves kind of late last year, but do you think the market still doesn't quite understand it because it's a niche mineral that not everyone follows closely?
Yeah, I think that's definitely the case, and some things take a little while to warm up, and I think one of the other challenges is sort of management is at a group of people are great explorers, and making that transition from exploration through development is actually a tricky phase, and it's a new learning curve for a lot of people, and I think management acknowledges that they made some mistakes early on, but there's an announcement today. They've just Rob Sennett is joined as an executive director, so he's great experience. He worked with MDL in mineral sands in Africa. Very successful, and I think bringing someone like Rob on board is a great part of recognising that transition that Peter Reid and the team were fantastic, and I can't speak high enough of Peter and the chairman Derek and Barry, the exploration geologist, and the other teams. I think they've done a fantastic job, and they'll continue to stay with the company and work. But I think there's a transition in that management skill and then the communication and marketing of that to the investment community. And I think once they start to pick up on that, I think the momentum will come back, because the stock did get up to, it was just shy of 50 cents at one point in the euphoria, but it's stuck around 25 cents or thereabouts at the moment.
How about if we hone in on some of the other rare earth names? I know we'd spoken in the past about Meteoric. What are you thinking of the Brazilian projects, the clay projects in general, given they had a real kick up on the back of all this Trump news in the past couple of weeks, and some of the individual names there? Are you invested in any of them?
Yeah, I think Meteoric is a real standout. And again, it goes back to the point I was mentioning earlier that it's good to chase big and high grade deposits, and they're quite exciting. But it's the ability to get them into production in a reasonable time frame and at a reasonable cost, particularly for these juniors. So it's very difficult for any junior to start a project with a $1 billion, let alone $1.5 or $2 billion capex. It's just it's just enormously challenging. And the investors who get in early are never the ones that make the money. So Lynas is a good example of that. If you got into Lynas at the beginning, you wouldn't be a happy camper today, even though the company's in the ASX 100. So it's like, well, at what point do you get in? It was, well, you can get in early, but you've got to get into those projects that can get into production with a reasonable capex and can do it quickly and can capture that opportunity. And that's why I think Meteoric in the space is a standout, because the grades, the size of that project, its ability to scale and become a really dominant producer is really exciting. And I think it's really got the potential to even challenge the Chinese themselves at their own game, because it's so much higher grade than what the Chinese have.
Why has the one producer that's emerged in Brazil so far, Sierra Verde, the private equity kind of mob that started that, why have they encountered issues to date, and would those issues be applicable to Meteoric, or are you kind of pretty comfortable that Meteoric wouldn't have the same issues?
Yeah, good question, Trav. One of the challenges, it's a privately held company. You don't see a lot of the information on it. But what we know, and I certainly look at the information that is available. That when they first started up, they were trialing an unusual processing method to extract the rare earths. There were problems with that. They then had to revert to the more conventional processing. That caused a few challenges. It's in an area of high rainfall. And so, processing of the ore in that environment was challenges. So they had a number of commissioning issues, and you've got to be very mindful of that. And again, it's like it is a competitive market, and the Chinese aren't going to give us a lot of help if we're trying to dislodge their dominance from that industry. So we need to look at groups like Serra Verde and the mines like that, and actually see what we can learn from that. But I think this is where we go back and you say, well, you want to start up, not too big a scale, but you want to sort of scale that process so that if you do have challenges, you're not going to sort of blow up the shareholder base. That you do something basic, get confident in doing that, then scale or expand that process from there.
What's getting you excited right now, Rick?
Talking to us.
No, excited in terms of the commodities. I think rare earths is certainly one. Obviously, gold. You can't go away from gold at the moment. And but if I initially talk about commodities, gold I think is really exciting. We've seen really interesting development in the gold space. If you go back 4 years ago, the gold price shot up and like all boats rose. It didn't matter whether you're a producer, a developer, an explorer, everyone went up. Whereas what we've seen in the last 12 months is initially it was the producers that ran hard, and normally that's what happens in a strong market. And then we came down into the developers. So we've seen great performance by companies like Meeka. And then it's the earlier stage explorers, companies with a mine. Maybe they need to do a bit of extra work. It's like the rocks resources, the Warradars. They're really starting to come on now. But a lot of those explorers are still languishing. The small explorers, they haven't quite got there unless you're doing something like a Brighstar, which that was a Houdini act to pull off a 3-way merger. I think that was an act of genius to pull that off.
He's done that many deals. He should be good at them by now.
Yeah, that's right. But it's like we've seen groups like that have done well, but a lot of the other gold explorers really haven't taken off. It hasn't moved down to that third part of the cycle, from the producers to the developers all the way into the explorers. We're sort of hovering, and part of the reason for that is you're seeing the developers are actually going through an expansion phase. Like even today with Westgold talking about expansion down at Higginsville, that suddenly that producer becomes a developer because they got this expansion pipeline on their thing. So people start to factor in that. So why do I need to go into an explorer if I can go into this producer that's going to expand their own production? So there's a lot of rotation within that part of the market. So outside of gold, I think uranium's been really bashed up. It's there's some good opportunities. I think Paladin certainly had its challenges, but it got to that overpriced, underpriced, really deeply discounted price where there's great value crept in, and then they announced the quarterly and it wasn't as bad as people thought. And I was a bit concerned leading into it, but on the announcement, got a lot of comfort. Now they're not out of the woods because they're still processing a lot of low grade stockpiles, and just because you have a good week or a good month on the low grade doesn't mean that next week or next month is going to be good. So there's some variability that could come out on that. The risk still remains. Boss is looking well. It's I think Duncan and the team have done a great job there. And then you go into things like Lotus that are coming up, and then outside of that, rare earths that we just talked about, domestic gas, and then copper. They're probably the preferred commodities.
I was looking at your top 5, mate. It's interesting, and it's probably different to a lot of the funds we've talked to. Like you can sort of discount Petratherm, as you said. That's bloody not luck. Don't undercall yourself saying it was just luck. I'm sure there was a lot of logic. But in terms of Boss, Meeka, Pantoro, and Westgold, they're sort of the interesting parts of the Lassonde curve. They're either ramping up or yet to sort of hit the levels that the market is expecting them to hit, which is probably, a different stage to a lot of funds that we talk about. So, but I think you explained a lot of it before. Uranium's probably looking for a bit of a re-rate, but things like Pantoro and Meeka, they sort of haven't, Meeka's in a ramp up there in that little fickly point, you'd say. Take us into that one.
Yeah, that's right. So I actually went out to site at Meeka. It's I think that's really exciting. That's the sort of opportunity that we love at Acorn, because it's through that ramp up that it's actually quite risky, that you have like a Bellevue that really struggled through the ramp up, and you can lose a lot of value. You think of how much the share price, how much the gold price has gone up in the last 12 months, and their share price has gone from essentially $2 to $1. So it's not just it's down 50%, but it's down 50% in a rising market, and then so there is risk in that ramp up, is the point I'm making. Then you look at Meeka, and where I was really concerned was late last year we went in the raise. I think there was a raise in about September, and then there was another one in early November when they took out the debt. And then what I was really concerned about was when they started the grade control drilling, that, well, what if the grade control, it doesn't reconcile as well back to the resource? So when you go from the resource model to the grade control model, but they've done some drilling. They've actually identified some nice thick zones with really good grades that are sitting just outside of the pit. And then the really exciting thing for me, and I don't think investors have quite picked up on this, is that the better grades are actually in the oxide zone. And so rather than just 18 months of oxide feed going into that mill in the initial year and a half of production, that you could actually extend that oxide feed for 2, maybe even 2.5 years. I don't know what the exact mine plan looks like, but you could get 2 years plus at higher grades in the oxide, which is softer and faster produced. That there's actually strong potential for outperformance in the next couple of years. So that's the sort of opportunity that I really like when I'm looking for those gold stocks, rather than just a steady state producer. And I think the management team, they're young, but they're really hungry and really enthusiastic. And so it's I really like the team. I like the project as it's coming together, and that's the sort of opportunity that we really like to pursue at Acorn.
Yeah, they're good for costs as well, because they're tight as a fish's arsehole, them too. So those Davidson fellas, so they won't be spending money they don't need to.
Yeah, and I'll tell you a funny story. I went on the site visit, and Tim's there, and then his brother's the CEO, and I'm like, I wouldn't say it's a red flag, but we're always a bit cautious about that. And then we drive up onto the ROM pad, and he starts giving some guy up on the ROM pad a bit of lip over the radio, and I'm like, geez, you're being a bit rough with one of your workers. And he turns and goes, oh yeah, that's my dad. So he's giving his old man a hard time. So what's your dad doing? He goes, oh, he's a retired engineer, but we needed someone to look after the civil. So he's coming in, and he's like got the whole place under go. So it's a real family affair, but it's not, usually you get really concerned about that. But I think it's I think this is one of the cases where these guys really want to make it succeed, and so they've wheeled the old man out of retirement and they've got a whip on him. So there was no favouritism from what I heard was going on over the radio.
That's hilarious, Rick. If we zoom out at the gold industry, I'm keen to look at this, because you wrote this paper a couple months back, I think, about how the evolution of bull markets sees the producers first rewarded, and then onto the developers and onto the smaller caps. But we look at your top 5 holdings there: Westgold producing, Pantoro producing, scaling up, and Meeka in that sort of ramp up kind of area. What sort of marks would you give to the ASX mid-cap goldies on how they've been able to convert this gold price into cash flow to start with?
Yeah, it's a really good question. If you go back again 4 years, that gold bull run, gold ran really hard, but the cost base came up faster than the gold price was rising, and that's where a lot of investors got burnt. They're going, well, the gold price went up, but no one actually made any money, and so I think that hesitation is still in the market. That, well, 4 years ago, no one really made money out of that gold bull run. Why is it different this time? And well, I think it's different for a couple of reasons. The gold price is strong, but we don't have that pressure on the base. But I think what's happening in the market is still that normal progression, and some of those mid-cap guys have been caught out by that. So a good example is you go and have a look at Perseus, or have a look at Northern Star up until a month ago. Both companies, you have a look at their share price, they peaked in about September or October last year, and then they went sideways. And that's the point that the Meekas and the Pantoros came along, and then they filled that gap. So that was a beautiful example of that re-rating. Now, in the last month, there's been a bit of generalist cycling into gold. They're going into the big liquid names. Into Northern Star, it's picked up. We've seen Perseus have another run, but on some positive news as well. So there is, broadly speaking, if you take out that last month, which there were some different factors involved, that's the cycle that you go into those big guys at the front, and then you move into the smaller ones. So it's not so much that some of these mid-tiers are doing it wrong. It's actually that their race is actually run, and now it's actually time for the next guys. And the only way that those mid caps can bring some life, I think they can bring life into their share price, is to do a bit like what Westgold's doing, which is show the path for production, for expansion, that you can do it without a big capital raise, with a modest capex that you can fund yourself, that you can do that in a reasonable time frame, really take advantage of that gold price and run, and that's the way that they can inject some life back into their share price.
Both Pantoro and Westgold in the cohort of gold producers out there, maybe on the higher end of costs, do you see them as favourable right now in the cycle because they have higher torque as the gold price appreciates than your lower cost producers out there too?
Yeah, that's definitely the case. And so with that comes risk. So what if the gold price pulls back a bit? The ones that are going to fall the hardest will be those guys. So you are taking risk around that leverage, but that's where the opportunity is. And again, it's like, well, you could have gone for the safe things like in last October and sat in Northern Star and Perseus, but then the stock price went sideways. Sure, it traded up and down a bit, but it really didn't progress in that phase. But these other guys that, like you say, Trav, with the leverage, that more risk in their ability to deliver, that's where the gains were made. So then that's my job as an investor at Acorn, is we're looking for those and say, well, where are they most likely to do that and to achieve what it is they think they can. And so Westgold's just an example. We weren't in Westgold until early this year when they had the bad quarter, but Wayne came in my office. We had a chat. He showed me the presentation. He said, "Look, this is what happened in October." Because I said, "You came in my office in early November, and it was like you said everything was going well." And then I look at the performance, and you did, and he showed me the breakdown. He goes, "Yeah, well, October was a good month," but he said November and December were terrible months, and these are the reasons. And he explained what the reasons were for the poor performance. And it was like, well, yeah, I get it. So that's something that you can actually turn around. And that's why we went in. We went in at that price. I think it was oversold at that point, and it went up. Now we've taken a bit of profit since that time, but that's a really nice opportunity where they had a few challenges, but they weren't they weren't the sort of challenges that lead to a major downgrade for the operation. It was more, okay, there might be some revisions around the edges, but that's already factored in by the fall in the share price. Now it's a matter of, well, is it oversold? In the case of Westgold, yes, it was. So we got in, leveraged it up. We rode it from, I think it was like $2.30 to $3 or thereabouts. And then we'll pull back and look for the next opportunity. But you've got to be nimble on those things. And when you see them, you go hard, take the gain, and then you just rebalance the portfolio at the appropriate time.
Would you welcome a merger between those two portfolio companies?
Good question. Look, if it makes sense, then we're all for those things. But
Does it make sense at these
well,
prices?
I think it's a good look. I think Norseman's like a really exciting area. If you go back the history of that region, even back in the days when Western Mining ran it, it was like Western Mining, and they had this funny joint venture with a company called Central Norseman Gold, which it was a separately listed company, and I know this because when I was like I think I was like 16 or 18, my parents said you can buy 3 lots of shares. And someone told me, I don't even know who it was, told me buy Central Norseman, and I got ANZ and South Australian Brewing, which own Coopers. I like beer, so I said I'll have that one. Dad to get a bank stock, and then I got this dodgy Central Norseman, and within 6 months of having it, it had gone down about 70%. So it was like a totally crappy investment, but eventually went up, and I made some money, but I had to hang around for about 5 years to make money. But anyway, that's enough of that digression. But anyway, they had it. The problem is because they were in this silly joint venture, no one wanted to spend money because it was like 49, 51% joint venture. So for decades, there was no money spent on it. But now finally, Pantoro's got this really big drill program. It's like, talks about 80,000, but it's probably 100,000 meters of drilling over the year that could be done in there, and drilling some fantastic targets. And it just hasn't had the drilling into what are some really exciting projects. So if you drill that thing out, if you have enough capital and you can focus on that, that's going to be exciting. Do they need to merge? Well, with the gold price where it is, maybe he doesn't. But if Westgold wants to pay a gigantic premium, then I'm quite happy for him to take it.
Because on the day we're recording today, Pantoro's quarterlies just came out, so they're about 2,000 ounces short on quarterly guidance, what they needed. So stock was down 10%. So between OK, Scotia, and then probably like their Rehab and Bullen, I guess how confident are you in, because it's going to underground feed, didn't really hit the grade mark this quarter, didn't look like, I had a quick look, but I guess how confident are you on the consistency of their ore bodies and delivering the grade?
That's a key question, Matty, in terms of what, are they going to be able to deliver? And that's something that, when I talk to Paul, it's always, getting confidence around that. And the March quarter was always going to be a difficult one in terms of, where they're at, accessing some of the stockpile material, obviously the stopes haven't produced the grades that they should have. But looking into you can see it in the forecast for the June quarter. The June quarter was always going to be better, and the March one was always going to be a bit touch and go. And unfortunately, it under delivered. But even though we'll take a shorter term view in terms of 6 or 12 months, I don't worry about things too much on a quarterly basis. That I always expected this to be a soft quarter, but I think with down 10%, that's actually a pretty good opportunity to get reset. So we see this as more an opportunity, because I think if they can deliver into the next 3 months, this June quarter, that'll be good. And another example of that is Bellevue, that it's been so bashed up, and went through the plan, went through the details of where they did mine and where they're going to mine in the next quarter. And Darren articulated that quite nicely in the presentations that he's had over the last few weeks. That that's another one where yes, there's a lot of risk whether they can actually out it, but because there's a big difference for Pantoro between delivering a bit over 18,000 ounces and then to deliver 23 plus. That's a big jump in production, but it's the type of deposit that can do that. And same with Bellevue, they've got the type of deposit that can. But the problem with these single asset companies with high grade mines is, they do have 1 or 2 quarters a year can be tough, but they'll also have 1 or 2 quarters of the years that'll outperform, and they'll be spectacular. And so you've just got to be mindful of that. So when it's going really well, probably want to take a little bit of profit because it's not going to be long before you have a tough quarter or two, and sometimes you have two tough ones in a row.
They're going to be there two good, very good ones side by side, I reckon, because size-wise, like Pantoro, pretty full spot gold exposure right now, bugger all debt.
No hedge book.
Yeah, no hedge book. Bellevue, but far out. Like if they, I don't know. Yeah, it'd be interesting to see if you've been having talks and like they've been presenting since they've been reinstated to quotation, because effectively they need to hit that 40,000 ounces. Like, and if they don't, because the talk about it is like, have they raised enough? Because if they are unhedged, but like if they don't make the most of this pretty much 9 months unhedged, they've got a bit of exposure in the December quarter. But I guess it can really go the other way with the covenants and everything. What's your vibe of them at the moment based on, meetings?
Yeah. Oh, look, to be very clear, I haven't spoken to Darren since or anyone at Bellevue since the raise. And they just presented the information. Asking questions around where where did they mine and what went wrong, and he explained what happened and why they got themselves into that situation. And so you could see that. So then it's a matter of taking that risk. But it's one of those things that's risk weighting. It's we don't have it as the biggest stock in the portfolio, but it's one that I think there's something you can take some risk on and have a look. But you got to watch very carefully in terms of how it's progressing, and just make sure that you don't become too overweight in something with that risk. Because if it takes off, it can go really well, and it could go back to $1.50, $1.60 very quickly, and that's a really nice upside in short term. But as you point out, Matty, it's if they don't, then they've got to do another raise. And one of the real risks around all of this is we don't know what the covenants are that the debt provider Macquarie's got in there. There's all these little catches. And I used to work for Deutsche in their debt finance business, and those guys are brilliant at putting little hooks and stuff all over the place. So it's the game that they play. So you got to be very careful. It may all look good, and suddenly they get pulled up for a little covenant that the equity investors have no idea even exists, and before you know it, they're off for another raise. And if they did another raise, I don't think it'll be at 85 cents.
I think wasn't one of them 20% of quarterly, like 20% of guidance. So if you're 20% below in a quarter, what your guidance was, like that's a covenant, which is
that one they spoke to.
You got to have one, and as you talk about, you have those one shit quarter. It's pretty easy to go 20% below guidance when you're low 30s. So.
Well, that's right. And the other thing is that the company hands over their model and says, okay, this is our mine plan, this is how we forecast everything. And then the bank applies its own sensitivities to that. So they'll say, yeah, well, that's all well and good, but we're not going to use that tonnage or that grade or that production number and adjust the recoveries, whatever. And it's their prerogative to do it. They'll get an independent technical expert, but to come in and sense check that. But it's very easy for them to sensitize down, the plan. And we don't know how much they sensitize it to run that model out. And that's where it's very difficult as an equity investor to do that. And that's why you just got to take the appropriate caution when you're looking at it. So is it cheap? Yes, it is, but it's cheap for a reason. And then it comes into risk weighting.
Oh, you know what the tech you need to get into is this could make you a fortune, because like the analysts for lithium, they can track via satellite and shipping and estimate how much ships of going in and out and get a pretty good prediction on how much lithium has been shipped by a company. Imagine if you could do that for the gold bars. If you could track how many bloody gold bars are going on the plane or something. If you can, there's no GPS, far out. So pretty much lithium research is better than
some sort
gold.
of weight indicator on the
there'd be so get everyone to weigh themselves. Oh, mate, there's a way. We'll chat after, Rick.
I think an Aussie fund.
I think you're onto something, Matty. I'm working on it now.
If we look at some of the other goldies, Rick, I think I saw that Gold Road was one that you were holding, or at least had held in the past. What's the end game for Gold Road and their sort of takeover drama?
Yeah, that's a look. Good question. It's one that we've been in and out over the journey. It's like, geologically, it's my favourite deposit. I describe it as probably the most boring place to work on the planet, because every day you work up, the grade's the same, the strip ratio's the same, recovery's the same. It's like you don't have to think to operate at that mine.
Go to Deterra.
But having said that, they've had all sorts of problems. So there is no reason for it to have the problems it's had. So that's clearly they had a cultural issue on site that people just weren't rolling up to work, and that's really disappointing. And it shows the importance of culture on site. Then
I feel like that was pointed out specifically by Duncan in the paper. He made a quote. It was something along the lines of that every quarter there seems to be an operational issue by the operators' goldfields, despite the fact Gruyere is this simple and predictable ore body.
It is. I think he's actually spot on the mark there. There was a real cultural issue. So they changed out the management, and that was early. Well, yeah, very early, like January last year. That Goldfields changed the management out. They put the necessary changes in place and really fix that problem. So to their credit, they fix that. And then usual story, when you have a bad run, it all goes wrong at once. So then they had the big rain event, and they were trucking stuff in literally from South Australia, from Perth into South Australia, then back into Gruyere just to get it to site. Ran out of reagents, fuel, food, everything. So there were a number of issues, but then they got behind on the mine plan, and then you're sort of chasing your tail a little bit until you get back on top of things. But I think they're close to getting that. It's obviously with the quarterly that came out today, they're not quite there yet. That still rectifying that plan. But the other thing they had was that stake in De Grey, that you could see that was pretty lucrative, and so that's why we held that late last year. Had a pretty sizable holding in that that was really big ballast. That sure, it was undervalued, but there was this residual value of that De Grey stake that really held it up. So we had a pretty large holding then. Then we sold out, and then they had the takeover bid, and strangely it was trading at about 15 or 20 cents below the bid price at the time. So we just went back in and grabbed a heap of that. But we don't have too much these days. I don't think it's now trading in line with the Northern Star share price, and that's what has really driven it. I've mentioned earlier that Northern Star has ticked up as a lot of people come into a big liquid gold name. That it's really just benefited from that. Now Duncan and the board are trying to extract a bit more value from Goldfields, and that may come, but it might be sizable, but it might be 2 or 3%. We're not here to make 2 or 3%. So I think there are a better opportunities out there. But like I said, it's a fantastic deposit. It's like geologically, it's a dream.
Rick, I'm pretty sure you were a 5% shareholder of Alto Metals, and then obviously the tie-up came with Brighstar. Have you rolled everything and still holding your Brighstar position?
Yeah, no, we're still there. Like I said, I think the three-way merger was Houdini Act, and I really like the way that the company is structured now. That they've got a really good development project around that sandstone region, because the problem was there were three main companies there that had ground, but all of them had sort of half to 2/3 of a mine, and none of them had the ability to actually become a mine. But when you consolidate two of them, you put 2/3 and 2/3 together, you actually get, the maths is dodgy, but just under one. So you bring these things together, you actually get rid of the junk, and then you've got something which is damn close to a mine. And then you just need the time and the money to drill it out, and to get a good team to drill it. And then at the same time, they've got their Laverton hub, and they're getting a bit of production coming out of there. The first batch was good. The second mine has started up. that, there's a little bit of cash flow coming from that. That's always a risky approach to have small scale mining, but in a bull market, you can actually get away with that. It's a bit, it's equivalent of DSO in lithium. No one would be thinking about DSO lithium today, but in a bull market, it made companies like MinRes a lot of money in a very short period of time, and so you can do that. But at some point, I think it will become a little bit trickier, and just got to be cautious around that. That these small underground mines, there's a number of them starting up. That means there's going to be there are going to be challenges finding the getting the productivity out of those mines as the more demand comes in for the jumbo operators and the air leg miners and the drillers and everything, because the skills required around running an underground mine are much higher than running an open pit. And so to find the appropriately skilled people might have been easy mid last year, but I think they're becoming more difficult from now on. So just a little bit of caution around Brighstar, but I it's stock that we still hold, have quite a reasonable position, and I think it's a great team and a great strategy. I think it's really appropriate for the market today.
I don't envy his job as a MD, to be honest. Like, between the sandstone work, the Menzies side, obviously the Laverton side, mix of development. He's got 2 producing mines now, the toll treating, and like, to be honest, for all the deals they've done, their probably share price hasn't ripped too much. Do you think they need to simplify the business and offload parts of it, or do you think there's a bit too much going on at the moment, or do you like that there's a lot going on?
Yeah, no, it's a good question. It's like, because the share price, really hasn't taken off, even though he's now got scale. He's got the momentum with the production coming on. He's starting to drill some, good holes. Initially, I thought that was, because of the merger, there's probably a lot of long-suffering shareholders in there that are using this liquidity event to get out, particularly in Alto, where there was never much liquidity in that stock. That there's people who've probably been there a long time and just want to get out, and it's like taking them time to get out, and finally here's the opportunity for the doing. But it really hasn't moved much. But I think there's probably just caution to make sure that they can actually make money from the mining, because like I said, it's not an easy thing to do, particularly in a small scale. That it can become quite expensive very, very quickly if it doesn't deliver. But it appears to be delivering. And I think if they get focused on the drilling and produce some good results, then that's what I think ultimately that's what's going to drive the movement in the share price. The gold production is a nice thing to do, but it's really the upside from exploration. That's why I'm there, and that's what's really got to deliver.
I actually think I remember sitting next to you and we were on a site visit around Diggers, and you pulled out your phone, you checked your announcements, and Petronas just popped up as a substantial shareholder of Alto, kind of amidst the potential deal there. What were your thoughts seeing these pesky agitators pop up in that deal at that point in time?
Yeah, look, you're really worried when that sort of stuff happens. But there was an opportunity, there's an arbitrage that opened up, and those guys are they're great at doing that, and they just worked that angle and did well out of it. So look, good luck to them. But I was a bit worried there for a while that it might block it, because I thought the merger was a great idea, and like I said, there were a couple of players in that sandstone area that they all had half or 2/3 of what could be a mine, and it's so hard to actually make it a real mine. So going back to production, it's like, you can get in production and you can start small, but you've got to very quickly move through to being a sustainable producer. And a good example of that is Luke Cray at Orabanda. That they started up that project. And I never liked it, because it was subscale, and it was like 60,000 ounces. For years I was saying, well, tell me the company that started producing in the last 15 years who started with less than 70,000 ounces and didn't blow up. and there wasn't one until bloody Orobander came along and proved me wrong. But two things happened there. The gold price went through this great run, but I think Luke and the team did an extraordinary job of positioning that company, getting through that 70, 80. Now they're up to the 100, and they'll be a sustainable 100,000 ounce per annum producer. But if he stayed around the 60 or 70, he would languish. And then if there's a pullback in the gold price, the first one with the lights to go out will be those small guys. So you've got to cross that divide. You've got to get to that 100,000 ounces as quickly as you can. Otherwise, you run the extreme risk of blowing up and having to shut down. And so that's why it's fine to start small like Brighstar, but they've got to have an end goal to actually get to something meaningful. Otherwise, it could be very costly if there is a pullback.
Rick, if we talk about the same sort of concept in a different commodity for a moment, AIC was another one you'd mentioned in the past. They're small scale, but bit by bit turning it into a bigger company. Where are they at, sort of, in your mind now?
Yeah, it's a good question. Like, you look in the copper space, and that's an extreme case of what I've been describing for gold. That you look at all the small scale copper base metal producers, they've just been disasters. They start up. I've got this great management plan and all the great management team and everything, but they never deliver. Now, AIC Mines was right at the bottom end of what you'd say is a sustainable operation when it was 10,000
tons per annum.
Tons of copper per annum in concentrate. They were just there, and they're producing a little bit of gold as well. But now with the Jericho acquisition, they're going to pretty much double that, and they're ramping up. And it was 10, they're going to creep up to 12. We're getting bigger, but I think they're moving into Jericho. There's been a few challenges with the ventilation shafts, getting that in place, but they're progressing really well. Once they get into that, then they're away, and they've got enough money now to sustain it. So they had a challenging period there, which I think Aaron did a fantastic job of managing in terms of raising capital at the appropriate time, not diluting shareholders, but moving the project forward. And I think now it's just a matter of getting the access drive across to Jericho, getting the ventilation, everything set up. And then as he starts to drill that out, you've got the potential for new discoveries to come out, but also the additional production to come in. Because the Eloise deposit, that's been not the driver of production in terms of, it's rich, it's high grade, but it's getting quite deep and more expensive to extract. They need to find alternate sources. And I think the team's doing a good job. So I think in terms of the copper companies, he's in that small moving into that moderate size. He's really at a interesting inflection point. And so I think that's one of the better copper opportunities. So then it's a matter of what your view is on the copper price in the interim, because that's what's really driving it. You saw their share price go from 30 cents to about 43 cents, and then it went back to, I think, 28. Now it's back to 35. So it's been a pretty volatile run. But I think the market's seeing that, it probably overran itself at 43, but it was ridiculously underpriced at 28. So somewhere in the mid-30s is probably right, but heading towards something higher.
I still remember when they raised capital in the 40s, there was a Twitter post went up, why didn't you do a share purchase plan for the existing shareholders? He's like, you've had the opportunity to buy them in the 20s and the 30s all the way up. Why would you want to buy them now? It was brilliant. He's quick-witted. I like him.
No, he's good.
Ding on that one. What about in the undeveloped project space, Rick? Like the resources in the ground that are not mines yet, be it gold, which is particularly hot right now. Where have you been deploying and adding to in your holdings right now?
Yeah, look, a good question. It's the Next Gen Resource Fund started nearly 5 years ago, and for a long time we were pretty close to 30% of that money would sit in explorers. And at the moment, we've got this roaring gold market, and you'd think you'd be cycling down, but it's running near all-time lows in terms of resource explorers, because it's, from memory, it was like about 23%, and it's been at those levels around 25 or just under for quite a few months now, and it's really difficult to see value in those explorers. And like, we really like Petratherm, obviously, which I talked about before, and we've got a sizable exposure in Petratherm that's dominating that 22 or 23% explorers in the portfolio. That there's a couple that I like, and then it's sort of slim pickings among them, and so we've got a few that are there, but it's always been a tricky space to pick those explorers. There are groups that do a great job, like funds that do a great job, like Johnny Forward at Lowell. He's the genius at picking those small stocks, but he runs his portfolio very differently to ours. He has a much larger number of stocks, so he'll place numerous bets across that, and that's obviously a great strategy, because he's had fantastic success. At Acorn, we're probably a little bit further up the curve. That yes, we do invest in some of those explorers, but what we're looking for is like a Petratherm that have made a discovery, drilled something. It's like, this is something that could become a mine. That's when we move in, rather than, he's a really good team, they've got interesting ground, let's go and back that exploration company. It's not the Acorn thing, whereas it's more a Lowell. They're invested across producers, developers, explorers, but they'll have a large number of early stage explorers, whereas it's pretty unusual for us to get too green on that greenfields part of the exploration curve.
Rick, I've got one more question, and I think it's a company that sort of fits that billing that I'd seen you'd held in the past, Patriot Battery Metals. What are you making of lithium more broadly, and how do you see those guys specifically navigating the Lassonde curve?
Yeah, another great question. I went out to site last September. So I went to Canada, and because I thought, the lithium price is down, here's a really good opportunity to go in and see. And I went to site, went and saw Patriot, Winsome, Sayona, went out to the Bécancour plant, which was Arcadium at the time, now Rio's hydroxide plant, lithium hydroxide plant that they're building just outside of Montreal. So we did a couple of site visits there, and it's like, in terms of the project, it's like outstanding project. It definitely is world class. The size, the grade. I think it's a fantastic project, and with Ken running it, Ken Brinston, it's got excellent management team. So it's got all the hallmarks for what you want in terms of a development project. The next thing you do when as an investor, you say, well, what's their ability to progress that project along the curve, and to actually make money in that. And we had Patriot last year, but I sort of came to a realization late last year that it was actually going to get very difficult for these developers to raise reasonable amounts of money in this market to advance the project. And so before VW came in and gave them some money, it was sort of a realization that those projects like Winsome and Patriot have got, they're just really challenging in the market that we're in at the moment. And so if you want to have exposure and take some leverage, you're probably better off being in a producer that's got enough cash to actually have a runway that they can survive the next, ideally, 18 months or 2 years. And so if it's a big company like Pilbara, if you want to see a rebound, or among the smaller ones, probably the best one is the Sayona Piedmont merger. That there's a company, they've got a lot of cash, they're producing. So if the price does turn, the first guys to run are the producers. So it's going to be Pilbara, Sayona. They're going to run quickly. I don't think you'll see much movement in the stocks like Winsome and Patriot, because the minute the share price runs, there's a high likelihood of a raise that'll follow, that'll really cap it. But these other guys, there's no need to raise money. They're away. So that's probably the way I'm thinking about lithium at the moment, that it's just too hard to be unless you've got a super long timeline. But as a fund manager, we can't. We've got to. We say we take a 3-year view, but people still measure my performance monthly. So I've still got to make some money in the interim.
Oh, the joys of it, eh? Very good.
Any more questions, lads?
Oh, I'd be interested, probably to close out that lithium one. Do you think we're going to see any deals while everything's depressed, like IGO, for instance? Speaking of one that'll probably rip because having the best hard rock exposure to the best hard rock asset in the world. I guess PLS has done their deal with bloody Brazil. Latin. Bloody went absolutely blank, but that's not going to be doing much. And we're going to potentially see IGO do something similar and pick someone up while it's all depressed. Because if you are in that company they pick up, you either have the choice you got the liquidity in IGO to get rid of your stock, or you got IGO in a depressed lithium environment. What do you think?
Yeah, look, I think there's definitely good potential, and that's always the firecracker in the mix, that that sort of thing could happen. To be honest, I was actually really surprised about Latin. No, it's not a project that I particularly like. It's a whole series of steeply dipping pegmatites, and so mining those things, you blast it, you can actually mix it. It's not ideal. Whereas Patriot makes a really good point that it's one gigantic, big, thick pegmatite. So that is perfect for mining, whether you're underground or open pit. That you're not going to dilute it with the host rock around it being the iron bearing basalt. So I was actually a little bit surprised by that one, and we've seen it. You guys might remember there was Oz and its takeover of a copper company. Oh, the name's just escaping me at the moment. It was a dreadful project, and they paid a fortune for it. So big companies make some crazy decisions when they got a lot of cash, and they think they see the bottom of the market. That what was it? Oz,
the Brazilian one
project.
The Brazilian,
With A.
Yeah.
The project it'll come to me after the show. But the point is, sometimes big companies make some poor M&A decisions, and I think Latin will probably go down as one of them. That I just don't see it as to pick something up at the bottom of the market. I think there are better things out there than that. But it's is there opportunity for other M&A? Definitely at these prices. I thought the price would start to rebound a little bit by now, because in terms of what the fundamentals were, all those mines that were shutting down last year, they were still shipping concentrate right up until late last year. And so it's only now that you're starting to see it come off. But, with Mount Holland starting up, a little bit of activity starting up again in Zimbabwe, it's just obviously enough to keep the price subdued for a bit longer than I thought it would have occurred. But people are, these companies, they're watching that. They'd be aware of that, and they'd probably be thinking about the timing, because the IGA timed it beautifully in terms of their Greenbushes acquisition a couple of years ago. That that they're probably thinking that again, that it's probably best just to hold out, get the timing right, pick the best project, and then you're away.
Just offset the nickel acquisition timing.
Yeah, that's right.
Yes.
Well, forget about that one.
No, that's all good. It's written down, mate. Let's start
just
again.
remember the latest one, this new one. Don't worry about that one.
Right. All good, lads.
All good.
That was bloody awesome, Rick. I like your holdings. You think the same way I do about these, producers. I like it. That's probably not a good thing for you.
Great to chat, Rick. Thanks for coming on Money of Mine.
Right, hey, good stuff. I like that. That was an in the middle fundy chat in terms of explorers big caps, it's like he's in that cool area that I like of developers producing and ramping. I liked it.
With a sort of geo skill set that Rick brings to it going up. Very, very interesting.
Yeah, bloody like it. Righto. Just as interesting as the GRX conference, the discount code, mate, MOM if you're an Austmine or AusIMM member, MOMNM, not member, if you're for 190 or 160 bucks off. It's the centre of tech and innovation. I can't wait to go. You're mad if you don't go. Get your bloody company's credit card and buy the tickets. They're pretty much free for anyone.
And a massive thank you to our other partners, Mineral Mining Services, Grounded, Sandvik Ground Support, CRE Insurance, K-Drill, WA Waterbores, Quattro Project Engineering, KCA Site Services, Black Diamond Drilling Services, and last but not least, Cross Boundary Energy.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.